What are DCF and multiples in startup valuation? Simply explained. Imagine trying to put a price tag on a startup that's still growing and changing every day. It's not as simple as looking at current sales or profits. Instead, investors use special methods to estimate what the company might be worth in the future. Two of the most common ways are discounted cash flow and multiples. Let's break them down so you can understand how they work and why they matter in funding and investment. First, think about discounted cash flow, or DCF. This method is like predicting how much money a startup will make in the future. You estimate the cash the company will generate over the next few years based on its plans, market size, and growth potential. Then, because money today is worth more than money later, you discount those future cash flows back to today's value using a rate that reflects how risky the startup is. For startups, this rate is usually high, sometimes over 25%, because they tend to be more uncertain. You also add a terminal value, which estimates what the company could be worth after the forecast period, often the biggest part of the valuation. This method is helpful because it looks at what the startup could become, not just what it is now. To do a DCF, you forecast future revenues, subtract expenses, decide on a discount rate, and then calculate the present value of each cash flow. Adding those together, including the terminal value, gives you an idea of the startup's worth today. You also consider the chance the startup might fail or be hard to sell, so you adjust the valuation accordingly. Next up is multiples valuation. This method compares the startup to similar companies or recent deals in the same industry. You look at metrics like revenue, earnings before interest and taxes, or user numbers. For example, if similar startups are selling for 10 times their revenue, you might value your startup at that multiple times your projected revenue. If your startup is expected to make $1 million in revenue next year, and the industry average multiple is 10, then your valuation could be around $10 million. Multiples are faster and easier to use than DCF, especially when a startup doesn't have predictable cash flows yet. But they depend heavily on finding good comparable companies and market conditions. The multiples can vary a lot depending on how fast the startup is growing, its industry, and how investors feel about the market. For founders looking to network and attract investors, understanding both methods is key. DCF shows the potential future value based on detailed financial projections, which helps in serious negotiations. Multiples give a quick benchmark against other companies, useful for initial talks. Many investors use a mix of both to get a balanced view of a startup's worth. When explaining your valuation, be ready to discuss the assumptions behind your numbers, like growth rates and risk factors. This transparency builds credibility and helps you attract the right investment at the right valuation.